Okay, welcome everyone to another exciting session here. I'm just gonna, you see, we're very candid and very open here. Start the recording. Okay, great. So I would love to welcome you guys to a talk today from Rob Smith. Now, it's tax season. It's perfect timing in that regard because Rob brings a lot of benefit to all of us with regards to our primary residence and how to make our primary residence tax deductible. This is a hot topic. It's been around, Rob, since when?
Since the mid-'80s.
Mid-'80s. So it's been around for a long time, but I feel like it's a hidden gem that a lot of people are not aware of. And the beauty is now we've got Rob who's promoting it and launching it. And a lot of people, I've spoken to many people in Victoria who swear by it and said it's changed their life and they've paid off their home in under 10 years, which now I think, what is it? The average home is being paid off in how many years now?
But by conventional methods or by the Smith Maneuver?
By conventional methods, 20.
Yeah. I mean,
20
people are
years.
taking on 25-year AMs.
Right. So I thought, you know what? I want to share this with others, and I've been lucky enough to come across you and meet you in person. So I'm excited to introduce you to my connections and my network. And without further ado, over to you, Rob, and tell us about yourself, and then we'll start the presentation as well.
Sure.
Great.
Well, firstly, thank you for having me on, Sharon. It's great to be here, and hello to everybody who's listening or watching. My name is Robinson Smith, and I'm the president of Smith Consulting Group Limited, which is a company founded by my father, Fraser Smith. And he's the gentleman who developed the Smith Maneuver back in the mid-'80s.
Great.
Yeah, he became a financial planner at that time in Vancouver. He was co-founder of Granville West, and he was a little annoyed by the fact that the Americans could deduct the interest on their mortgage, but we couldn't up here in Canada. So he wanted to level the playing field, and he developed a strategy which he called the Smith Maneuver. And he put his private clients into that up until around 2000. So it wasn't widespread. He didn't really get the word out. It's just private client base. Mm-hmm. But he wrote his book in 2002. The Smith Maneuver is your mortgage tax deductible. And he's a bestseller with that book about 7 times over in Canada.
Wow.
So he retired from planning to write the book, but came out of retirement in 2005 in order to be another financial planner again. So I joined him in 2006, and he and I had our separate advisories based out of Victoria, just in Sydney here. Mm-hmm. So we put over 500 families into the Smith Maneuver, and recently relaunched the marketing campaign because we hadn't done any marketing or advertising for all those years. All the business we got was simply from referrals from existing clients or other financial professionals. So rewrote his book. That came out in November, and now I'm just busy getting the word out to Canadians. I sold my advisory business in order to focus on marketing the strategy and attracting financial professionals to become Smith Manoeuvre certified.
Excellent.
They could help Canadians implement the strategy.
This is excellent. So I want to know, I'm sure myself and others want to know more. Okay, so how does this whole strategy work?
Do you want me to dive into the PowerPoint at this point?
Yeah. If you could share your screen, that'd be great. And then we could see.
Okay, so are we looking at it?
Yep.
Okay, great. So the Smith Maneuver. The most difficult thing about this strategy, I think, is to spell it. Nobody ever gets maneuver correctly.
Yeah.
There it is. It's mortgage tax deductible. Now, there is quite a bit to the strategy, but I'm going to go through it relatively quickly. There's always more information that you or your listeners can gather by going to the website. But we'll go through it relatively quickly. So this strategy is for someone who owns a house in Canada, principal residence, and has a mortgage. Mortgages are not tax deductible. So they're very expensive. And the fact is that this mortgage, this very thing that allowed you to buy your home where you can raise your family in peace and serenity, is also the very thing that threatens your peace and serenity. Why? Because it's so expensive. Mortgages are not cheap. The true cost of a mortgage. So what does a mortgage really cost you? If you've got a $400,000 mortgage, 4.5%, 25-year AM, and you're at the 38% marginal tax rate, how much do you have to earn to pay back that $400,000 mortgage? Well, firstly, you have to pay back the bank $400,000. You also have to pay back interest on that loan. Plus, it's non-deductible. You have to pay tax on your income before you can make that mortgage payment. So the true cost of that mortgage is over $1 million. You have to earn over $1 million to pay back that $400,000 over 25 years. Terribly expensive. And we Canadians don't have it easy. We've got high taxes. You know, the typical Canadian pays around 50% of their income in taxes. Federal, provincial, municipal,
Yep.
Everywhere, right?
And it's only going to get more now.
It's only going to increase.
Right.
We've got inadequate pensions, right? We've got CPP and OAS. They're clawed back. People aren't able to save enough for themselves for their futures, for their retirement. We got expensive mortgages. We got kids we got to pay for, inflation, and on and on and on. And we Canadians generally have two very pressing financial goals. One, we want this expensive mortgage gone. We're happy to allow us to buy this house, but we don't want this big payment. Secondly, we know that we have to prepare for retirement. We want to be able to slow down in our older age or retire altogether. But the decision on which of these important goals to attack first is made for us, not by us. Because of our limited incomes, we can only afford to do one, typically. Mm-hmm. And if we do not contribute to our retirement plan, no one's going to come knocking on our door. But if we do not contribute to paying our mortgage down, someone is going to come knocking on our door. They're going to want our house back. So generally, we attack the mortgage and then retirement once that mortgage is gone. But that means we're missing out on 20 or 25 years of compound growth. That is extremely expensive to our financial well-being. And if we're busy paying off this mortgage for 25 years, only then to start being able to save for our retirement, it's too late. We don't have sufficient savings for our retirement. So where does that lead? Well, for a lot of Canadians, many Canadians, we end up living on a small fixed income. And a lot of your listeners, yourself as well, Sharon, will know someone who lives in a house worth $800,000, no mortgage, but they got to live on a fixed income.
That's right.
Or we're being financially reliant on our children. We have to live in their basement, for example, when we're retired. We're being forced to downsize whether we want to or not. We're being forced to sign up for a reverse mortgage. So all our lives, our working lives, we're working for the bank, paying down this mortgage. Finally, we're mortgage free at 65 years old with insufficient savings. So what do? We have to sell the house back to the bank. Lastly, what is our potential destiny? Right? If you go to Costco, Walmart, Burger King,
funny.
Have a look around. You'll see many senior citizens working there, and they're not there because they want to be there. They're there because they have to be there. So no one's got our backs. We need to take care of ourselves. The best way to do that, a few ways: reduce our tax bill, eliminate costly expenses as fast as we can, and invest for our future as early and as often as possible. Take advantage of compound growth. Now, when discussing the Smith Manoeuvre with Canadian homeowners, a big discussion revolves around debt. Many people don't really distinguish between non-deductible debt and deductible debt. They're not educated to the point where they understand that non-deductible debt is a destroyer of wealth. Actually, maybe they understand that very clearly because they've got consumer debt and this mortgage, and it's tough to build wealth. But they don't understand that deductible debt is a creator of wealth. And when we're talking about the Smith Manoeuvre, we're talking about using the equity in your home to your advantage. If you're busy paying off this mortgage from $400,000, $500,000, $600,000 down to zero, meanwhile, the value of your house is typically rising, you're generating huge amounts of equity in your home, which is available to you to put it to work. But if you do not put it to work, this unproductive equity is earning 0%. In fact, it's earning less than 0% due to inflation. So unproductive equity equals negative return. So my mission right now is to educate all Canadian homeowners, whether they feel the strategy is for them or not, that this strategy is available to them and that their mortgage can be one of their biggest investment opportunities. So what is the Smith Manoeuvre? The Smith Manoeuvre converts your mortgage debt into 100% tax-deductible debt. So you've got this big mortgage. It's not tax deductible. A big chunk of your paycheck goes to paying that mortgage down and also to paying non-deductible interest to the bank. Well, we're going to convert that debt to tax deductible debt, which means you're going to get a tax refund on an annual basis. Your tax bill is going to reduce. You're going to be able to take these annual tax refunds, which you otherwise would not have received, and make prepayments against your mortgage. So this is cash that you otherwise would not have. You can use it to pay down your mortgage, which means it disappears very quickly. Plus, necessarily, you're going to build an increasing free and clear rate investment portfolio, which is going to be there for you in your retirement. It happens now, it happens simultaneously, and it does not need any extra cash from the homeowner. All it requires is a refinance of your home, and you can start to put your mortgage payment to work for you. So here's the typical mortgage. This is what many Canadians have as borrowing against their home. They go to the bank, they get a mortgage, and they swear to their spouse, their God, and their banker that they're going to pay off this $400,000 mortgage loan in 25 years, principal plus interest payments. What a homeowner needs in order to implement the Smith Manoeuvre is what's called a readvanceable mortgage. And many homeowners already have one. They don't necessarily went in consciously to get this readvanceable mortgage for the purposes of implementing this strategy, but they have one. Many people don't. If you don't, you need to get into one. The idea is the bank is willing to lend you this $400,000 non-deductible mortgage loan, but they've also got a line of credit which is attached to that that mortgage loan, so it's also secured by the house. And whatever equity whatever principal balance you pay down on that mortgage, you can borrow it back. So, for example, if you've got a $2,200 mortgage payment, this is why the banks are so wealthy. $1,470 of that is going to them in interest. That's
Interest.
right?
Wow.
Privilege you pay to them for having borrowed their money, which in a sense is fair. But only $730 reduces the principal balance on that mortgage. So now it's down to $399,270. What happens is the bank says, you've paid down to $730 on this loan. We're going to let you borrow it back, and you can do whatever you want with this money. What we're going to do is invest. Now, the use of this borrowed money on a monthly basis is very important. If we borrow to consume, so if we borrow that money, $730 in this case, to make a Mercedes payment or go on vacation or buy groceries, we do not get to claim the interest on that as a tax deduction. But if we borrow with a reasonable expectation of generating income, we can deduct the interest on that. So the use of this borrowed money on a monthly basis is critical. And what we're going to do is continue to reborrow the increasing equity that we have in this house on a monthly basis. And we're going to convert that non-deductible debt on the left to deductible debt on the right. So by the time we finish this conversion, the interest on that $400,000 is fully tax deductible. That is a lot of money coming back to you at tax time. So
sorry, Rob. I think for some of the viewers, they may question like, oh boy, you've got now all your debt now in a line of credit.
Yes. But we go out and we buy our house, we get this mortgage, and we've got $400,000 of non-deductible debt. And we're content with that. It's provided us a place to live. It's scary, right? Sometimes it's expensive. But if we convert that $400,000 of non-deductible debt to deductible debt, excuse me, then we're generating these tax deductions. One of the biggest things here when talking to Canadian homeowners is exactly what you just said. You're asking me to maintain my debt rather than pay it off. And the answer is yes. There's a reason for that, though, is because you're going to start to reduce your tax bill on an annual basis. Mm-hmm. You're going to get these tax refunds. With these tax refunds, you're going to be able to make annual mortgage prepayments, which means less interest payments on that non-deductible mortgage over the course of time. Plus, the only way you generate these tax refunds is if you borrow with a reasonable expectation of generating income. So you're investing, you're earning compound growth, not only with the monthly investment that we're partaking in here, but also when those annual tax refunds come, we're overpaying our mortgage, reborrowing that amount as well to get it invested.
So Rob, so that $400,000 now is sitting in investments. So you've got a $400 debt that's deductible, but mm-hmm. also you have $400,000 in investments that are growing at at the market or whatever investment rate it is.
That's right.
Okay,
That's right.
gotcha.
So not only that, but you also have the house value, which is increasing.
That's right. That's right.
$1,000 debt on this line of credit it's fully tax deductible, but it's just displaced equity. If I did not have that $400,000, if I did not put that loan to use by investing, it would be sitting as unproductive equity in my home. Now that made me feel good, right? I feel great, but I got 400,000 more than that because the value of the house is now 5, 6, 7, 800,000. But I've got all this equity earning me 0%. Meanwhile, if I'm doing the Smith maneuver, I've pulled that equity out and I'm earning 6, 7, 8% in the markets. Now, granted, this is a particularly strange time. We're going to see the value of these investments fluctuate. But we know the stock markets exist for a reason. Mutual funds, securities, bonds, they exist for a reason because they generate decent returns on a long-term basis. And this strategy is as long-term as it gets, right? This is not a get scheme. It's let's start now when we're as young as possible, when we're 35, when we're 40, 45, 50, whenever it is, and let's stay invested over the long term. So,
gotcha.
So what is the strategy worth to the typical Canadian? It's worth about $400,000 in improvement in net worth. And this is just what we call the plain Jane Smith maneuver, which is what I just described. It is simply using the regular mortgage payment, which you are making anyways. Whether you do the Smith maneuver or not, you're making that $2,200 monthly mortgage payment. But if you execute the Smith maneuver, you're going to see an increase of about $400,000 in net worth. But there are accelerators for the strategy, which greatly improve the results. There's the debt swap, cash flow diversion, drip accelerator, prime the pump, cash flow dam. So there's a number of ways that people can utilize the cash flow that they're already outlaying to accelerate the results of this program. And I'm going to describe one here, prime the pump. If I go and buy a house and it's worth $500,000, I can get percent, so $400,000, because 20% equity is required for a readvanceable mortgage. So at this point, the line of credit, you'll see on the right side, the limit on that is 0. I've borrowed the full amount I can for non-deductible mortgage debt. But what happens if, say, I go and get my house appraised because I want to do the Smith maneuver, and the value comes in at $600,000? Well, that means my new lender for the readvanceable mortgage, they're willing to lend up to a total of 80%. So they're willing to loan $480,000. But I only need $400,000 to pay out my old lender with the mortgage that doesn't work. Now, I understand 5% HELOC rule, but we've got a Smith Man calculator, which accounts for all of that. But in general terms, if I've got available equity right off the bat, in this case, $80,000, I can do whatever I want with that. I can pull that out. I can invest in securities. I can invest in mutual funds, stocks, bonds, my business, your business, or investment real estate. Maybe I take that $80,000 and I use it as a down payment for a rental property. And then I continue on with the Smith maneuver process, which is reborrowing subsequent additional equity created by that regular mortgage payment or any other accelerators I'm using. If I go and buy a rental property, or if I have one already, what many people are doing when they own investment real estate is they've got renters in there and they're receiving $2,000 in rental receipts. What are they doing? They're taking that $2,000, putting it in their bank account, and then turning around and paying the mortgage on that rental property or the expenses to maintain the property, right? They're missing out on potentially hundreds of thousands of dollars of benefit here. If they implement the cash flow dam, then when they receive that $2,000 in rental receipts, what should they be doing? They should be taking that $2,000 of rental receipts that they receive, making a prepayment from rental revenues against the mortgage on their principal residence, the non-deductible debt, the house in which they live. And when that line of credit increases its limit dollar for dollar, which it does with a readvanceable, you can reborrow that $2,000, put it into your rental property bank account, and then service the mortgage on your rental property. So
a question, Rob.
Yes.
This is awesome. Wow, this is great. So here we have the rental property, the income coming into the rental property. So for your primary residence, when you are doing the Smith maneuver, where is that additional income coming in to help you pay it down? Is it from the investments, the money made off the investments that come back in and helps you pay it down? Because then you're stuck with the same mortgage payment for the whole time.
On your principal residence or your rental?
Principal residence. If, let's suppose you have no rental property. With the rental property, it's nice because you get the rental income coming in. But on your primary residence with no rental property, where is that additional income that's coming in? Because you've got now more, your debt's increasing, it's being invested, you're just continuing to pay the same mortgage amount. Is there additional money coming in to help you pay it down from the investments?
I'm just going to hold on this slide for a second to answer that question. And
Excellent.
It is a fantastic question. This is a question that pretty soon everyone comes up with.
Right.
They say, Rob, whether or not I'm doing the Smith Manoeuvre, I've got a $2,200 mortgage payment each month.
Right.
If I'm not doing the Smith Manoeuvre, that's all I have to find. But if I am doing the Smith Manoeuvre, I still have that $2,200, but now I've got an increasing balance on that line of credit, and that has to be serviced on a monthly basis. And if you're telling me no new cash has to come out of my pocket, Rob, then how is the interest on that line of credit being serviced? Is that your question, Sharon?
Excellent. You hit the nail on the head.
And the answer to this very good question lies in the fact that your mortgage payment is increasing in efficiency. So month one, we saw how much was going to interest. Only $730 reduced principal out of that $2,200 payment.
Right.
Month one, I reborrow that $730 and I get it invested. Month two, however, I still have that $2,200 mortgage payment, but a little bit less of that goes to interest. A little bit more goes to reduced principal. So say $732, because I'm making a mortgage payment on a smaller balance than I was month previous.
Right.
So now instead of 730 reducing the principal, I've got 732 reducing the principal.
That's right.
That means the line of credit limit opens up by $732. I pull that $732 out into my account, my bank account, and a few days later during the month, the mortgage lender says, okay, it's time to pay the interest on that first month's borrowing of $730. So they come into the bank account and take $2.
Right.
And that leaves $730 to get invested. Next month, 704 reduces the principal. I borrow back 704. They come in for interest on 2 months previous borrowing. So they take $4. I still have 730 to invest. Mm-hmm. So the increasing efficiency of that regular mortgage payment is servicing the increasing interest expense on that line of credit, which in fact is deductible. So therefore, even if that line of credit rate is 4.5%, the fact that it's tax deductible means the real rate of that line of credit is lower than 4.5.
Gotcha.
So on the smithman.net website, we've got a frequently asked questions section, and it addresses exactly that question you had.
Good.
And of course, I discuss it in my new book as well. So just quickly back to this. Instead of taking rental receipts and turning around and making the mortgage payment on your rental property, take those rental receipts, make a prepayment against your mortgage, reborrow it, and then service the expenses on that rental property. You're borrowing with the expectation of generating income because you're investing in your business, which is already actually generating income, the rental receipts. So the interest on that borrowing from the line of credit is tax deductible. Now, we've got the Smithman calculator. It's available on the smithman.net website, and it takes all your existing, your current financials, so your income, your assets, your liabilities, what are your mortgage details, what are certain assumptions you want to make about rates, investment growth of your portfolio, etc. So here, I'm just using an example of someone who makes $100,000 a year. They've got a $400,000 mortgage, paying 4.5. There's their mortgage payment, 2214, 25-year amortization, and they're at the 38% marginal tax rate. The two lines at the bottom here, line of credit rate, that refers to on a readvanceable. Obviously, that's secured line of credit from which you're going to be reborrowing each month. And we're assuming an 8% growth rate on your investments. Again, the calculator allows you to plug in 5, 6, 7, 8, 10, whatever you want. But the results here of the plain Jane Smith maneuver are as follows. You're going to see a taxation improvement of $204,000. So there's the deductions you're going to earn over the course of the amortization of your mortgage, 25 years in this case. This program is going to take 2.75 years off the amortization of that non-deductible debt, and it's going to create a net worth improvement of $430,000. So that $430,000 means while the investment loan, once you've finished converting your mortgage, is the original $400,000 mortgage balance, you still have $400,000 of debt secured by your house, but your investment portfolio is worth $831,000. So we're taking the total portfolio value, subtracting the amount of deductible debt, that investment loan, and that's where we arrive at the $431,000 net worth improvement. Now, let's add some accelerators. Debt swap. I've got $20,000 in mutual funds, let's say. I've had that for a while. What I can do once I have my readvanceable mortgage is redeem $20,000, take that cash, prepay my mortgage, reborrow it, and a week later, repurchase those assets if I want to, or purchase different investment assets. I'm still invested that 20 grand, but I've pulled it out of my investments. I paid down non-deductible debt by 20 grand, pulled back 20 grand in deductible debt, and got invested again. If I've got $10,000 in an emergency fund, if I'm comfortable and I have alternative source of emergency cash available, such as a personal line of credit, I'm not going to touch unless it is an emergency, I can take that cash, prepay my mortgage, borrow it back, and get it invested. Cash flow diversion. Say I've built up that $20,000 of mutual funds by contributing $500 a month. I'm already outlaying that. Well, first, instead of investing directly into funds from my bank account, I'm going to prepay my mortgage by $500, borrow it back, and then buy the investments. There's the cash flow down. I'm receiving $2,000 from my renter each month, prepaying my mortgage, borrowing it back, and in this case, I've got $1,833 per month in expenses. The difference gets to get invested in securities. Annual drip yield of 4%. This is saying I'm taking the dividends from my investment portfolio, instead of having them get reinvested automatically to buy the stock on a monthly basis or the mutual fund or whatever it is, I'm taking that those dividends in cash, prepaying my mortgage, reborrowing, and then buying the same stock that they would have if they automatically got reinvested if I wish. And lastly, prime the pump. I'm going to pull $40,000 out of my available credit as soon as I refinance to get it invested directly. So here we see a taxation improvement to $433. I'm now saving 18.92 years.
Wow.
So let's say I'm saving 9 years, which means that non-deductible mortgage debt is not gone in 25 years, it's gone in 6 years.
So Rob, I mean, this stuff is great, and it gets a bit technical here. Will there be someone that, for example, if I want help on this, that you can recommend to me that I could follow up with to help me?
Absolutely, 100%.
Excellent. Okay, good.
About that maybe next slide or two.
Okay, great.
So lastly, the net worth improvement is over $2,000. So compared to zero tax deductions, if I don't do the Smith maneuver, if I do the plain Jane, I'm getting $204. If I use the accelerators, I'm getting $403,000 in deductions. Instead of saving 2.75 years, I'm saving 18.9. Net worth improvement with the plain Jane Smith maneuver of $431,000 is still $431,000 better than not doing the Smith maneuver. But if I use the accelerators, my net worth improvement is over $2 million. So the Smith-Man calculator is very powerful in allowing you to throw in a whole bunch of different assumptions and seeing what you can arrive at.
This is crazy. This is great. From 400 to 1 million. What percentage is that? Wow.
A big one.
A big one, right? Wow.
So a quick summary here. This is not a leverage strategy. The Smith maneuver does not require you borrow new money. The leverage already occurred when you bought the house. You went and leveraged at that point. All we're doing is converting debt from non-deductible to deductible. So it's a conversion strategy. What we've talked about already when talking about priming the pump, when taking out additional available equity, that is leverage. So that's a discussion you're going to want to have with your financial professional if you want to do that or not. But everything else requires no new debt.
Okay.
It's one-time restructuring. If you're in the wrong type of mortgage, get into the right type of mortgage, and away you go. Requires no new cash from you on a monthly basis. So this book you're seeing on the right, Master Your Mortgage for Financial Freedom, that's me rewriting Dad's book from 2002. I've updated it with more recent values. He talked about a $100,000 mortgage. Well, nobody's got a $100,000 mortgage.
Right, exactly.
And I made it a little more approachable for your average Canadian. Fraser was pretty technical and numbersy. So we've got the book, we've got the Smith Manoeuvre calculator, which we kind of talked about just now, and the Smith Manoeuvre homeowner course. That's a course that's available, again, on the website, smithman.net, for Canadians who want to read up more on the Smith Manoeuvre. I couldn't put everything in the book.
Great.
Lastly, what you were asking about, Sharon, the Smith Manoeuvre Certified Professional Accreditation Program. This is what I'm busying myself with these days. I'm setting up this accreditation program because I can get the word out to all of Canadian homeowners across the country and let them know about this. But if they want to do it, where do they go? And I don't want them going to financial professionals who don't understand the strategy themselves. I want to ensure that if Canadians want to implement this, they have realtors, mortgage brokers, investment advisors, mortgage conveyancers, insurance agents, and accountants who are Smith Manoeuvre certified professionals who can help these Canadian homeowners, all of them, because a Canadian homeowner is going to need all of these types of professionals. And so if you're in Kitchener-Waterloo and you need a mortgage broker, you go talk to a mortgage broker, you get set up, he can refer Smith Manoeuvre certified professional, realtor, advisor, insurance agent, accountant. So all these professionals will be able to encircle the client, if you will, and be able to take care of all of their financial needs with a complete understanding of this particular strategy that they're undergoing.
That's great.
So that certification program is underway. From Halifax to Victoria here, we're accepting financial professionals in these various professions and getting them trained up. There's a course they go through and an exam they write, and then they get certified and they're able to market themselves as Smith Manoeuvre certified professionals, and they get a whole bunch of support from me here at the Smith Manoeuvre. Currently, we'll be doing webinars to their clients, but in the near future, we hope to be getting back out as soon as everybody's comfortable and filling auditoriums with SMCP advisors, clients in Red Deer.
Yeah, because I do see this, really being needed.
Well, I've got inquiries already from Canadians who have read the book. I mentioned the Smith Manoeuvre Certified Professional Accreditation Program. So I've got inquiries coming in every day from all across the country from people saying, I want to implement this. Who do I talk to?
Great.
And I just noticed I misspelled number on point number 1.
Okay. Too funny.
Yes, so that's underway. I'm really excited about that because it is extremely important to me that, we've heard many stories of financial professionals advising on the Smith Manoeuvre, and they don't have it right. And
that's
so
right.
If you go to an investment advisor or mortgage broker, and they say they're going to help you with the Smith Manoeuvre, if they're not certified, then they're not certified, and you don't know what you're getting.
Right.
And it's so important because we're dealing with amortization of mortgages. We're dealing with investments. We're dealing with the CRA on the tax side. So you need people who know what they're talking about.
That's right.
And
I like that. Wait, can you go back to that quote? I like that. Procrastination is the enemy of your financial success. Yes, just do it.
Just do it.
Right.
So lastly, smithman.net. It's got all the information you need. If you need more information, you can always email us at info@smithman.net. Whether you're a homeowner looking for more information or a financial professional looking about accreditation.
Excellent. Wow. Thank you. Thank you for this. And here we go. All right. So we're just going to have a quick discussion because I am getting questions by email and I do have some questions for you. So question number 1 here, what is the best mortgage to get in order to implement the Smith Manoeuvre? I guess you went over that anyways, but please go over it again.
Not specifically.
Okay.
Almost all the big banks out there and other types of mortgage lenders have their own version of the readvanceable mortgage. But
Gotcha.
not every readvanceable mortgage is created equal. What might be best for this homeowner is not going to be the best one for that homeowner. So again, this is why it's so important to talk to a Smith Manoeuvre certified professional mortgage broker, because they know all the readvanceable mortgages out there, and they can take your personal situation and say, okay, this one's going to be right for you. This one is not going to be right for you because the prepayment penalty is too restrictive. If you're doing the cash flow dam and you want to prepay your mortgage by $2,000, $3,000 a month, sometimes you're not even able to do that with different readvanceables. So you need a Smith Manoeuvre certified mortgage broker.
Okay, no, that's a good point. Another question I've got here. Would I want to max out my RSP contribution before doing the Smith maneuver?
This is a question I see. Actually, not necessarily a question I see frequently. I see people advising that, yes, do the Smith maneuver once you've maxed out your RSP contributions. And the reason that that is an incorrect answer is because you make your RSP or TFSA contributions with after-tax dollars, right?
Yeah.
So regardless of how much you're contributing with your cash, by implementing the Smith maneuver, this is incremental money that you're able to get access, right? Mm-hmm. So you can continue to max out your RSPs, TFSAs, but the money you reborrow via the Smith maneuver, that needs to go into a non-registered account, because they won't allow you to deduct the interest if you borrow to contribute to a registered contribution. So it is completely separate. The Smith maneuver is incremental to contributing to your registered assets, regardless if you're maxing them out or not.
Okay, and then, okay, so there's another one here. What's the difference between a reverse mortgage and a readvanceable mortgage?
Yeah, we touched on that briefly. A reverse mortgage is that's something that you acquire when you're sort of more mature, shall we say. You know, we've seen the ads. If you're 55 or older, you can access up to 55% of the equity in your home. These are specifically designed for Canadians who are unprepared for retirement. They need to start effectively selling their house back to the bank because they don't have personal savings. So they're receiving money from this lender that can finance their retirement. And the balance that they owe the lender increases over time, because one of the things with a reverse mortgage is you don't have to make payments on it. So if I owe $2,000 for the first month's borrowing from this reverse mortgage,
that's right,
it gets added to the balance. So $402,000, $404,000, $406,000. So by the time I pass away 20, 30 years later, maybe the amount that I owe the lender is more than the value of my house. So the kids get nothing. Now that's an infrequent occurrence, but it is possible. With a readvanceable mortgage, this is what we get now. And it allows us to access the equity on a monthly basis and get invested for growth, so that we can avoid the necessity of a reverse mortgage.
So here's another thing that just came to my mind now. So the mortgage, the investment, your mortgage, sorry, I've got a few thoughts going on. I'm getting excited here. So your mortgage now becomes tax deductible. It goes into investment, and also the investment is taxed at a lower rate, because I know dividends from stocks are taxed at a lower rate than normal income. That's as right. Well. So you're saving there as well. So
once you've been doing this for a while and you've got this investment portfolio built up, now you want to slow down at work, or now you want to retire.
Right.
Well, you start taking income from your investment portfolio. And if you start taking dividends from a $1.4 million portfolio, that's not an insignificant amount. So you're taking your income in the form of dividends, and you're getting taxed as dividends, which is maybe 33%, versus if you're taking cash flow from an RSP, you're getting taxed at your full tax rate at that time. Right. So it all depends. It's much more tax efficient when you're pulling money out to do so from a non-registered account than it is from an RSP.
That's right. Wow. Oh, that's very helpful. Okay. And then what other questions do we have here? I've heard that selling investments you already have and overpaying your mortgage is a Smith maneuver, but that doesn't sound to be the case. Can you expand?
This is something that we frequently see, not just from Canadians in general who are interested in the Smith maneuver, but also from financial professionals and from the finance media. I think last year I saw someone wrote in the Financial Post, a journalist, okay, here's the Smith maneuver. You sell your assets, you prepay your mortgage, reborrow, and purchase the same assets. That's just a debt swap. That's the debt swap accelerator. So that's done on a periodic basis when you have access to a decent amount of funds. The Smith maneuver itself is having this occur on a monthly basis, regularly. Each month, whatever goes down on your mortgage, you're able to reaccess and get it invested. So there's a number of different accelerators. But again, the debt swap is quite frequently described as the Smith maneuver itself. It's just an accelerator.
No, this is great. I mean, I'm getting lots of questions here, but I want to use this opportunity to answer my questions here too. I think I get first dibs. And for everyone else's questions, we will follow up by email. Just email. We'll send out an email where you can send questions to, and we'll follow up on them. So one of my own questions is, like, I'm a real estate investor. I'm a realtor, and I invest a lot in real estate, and I do consulting as well. How is this going to help me as a real estate investor? That's one thing I want to know.
As a real estate investor,
Right.
got this helps in a number of ways.
Right.
Firstly, maybe you already have a rental property. You want more. Well,
right.
When if you find out about the Smith maneuver, you're interested, you want to do it, you refinance your house. And again, you might have, because the mortgage that you've been paying off conventionally has come down a bit over time, very slowly, but it's come down. The value of your own house has gone up a little bit. If you refi into the proper mortgage, again, you might have some equity that you can pull out right away and go and use towards purchasing a second piece of investment real estate.
Mm-hmm.
If you have one or will have one in future, then you can implement the cash flow dam accelerator as well, which is extremely effective in compressing the amortization of that non-deductible mortgage. Now, if you're interested in investment real estate, but haven't found a way to get in yet, and when you refinance your home into a readvanceable and you still don't have enough equity in there to pull out right away to buy your first piece of investment real estate, well, you can implement the maneuver and pull out that monthly available equity, get it invested, and it doesn't take long for $1,000, $1,300 a month getting invested to accrue to an amount which is suitable for a down payment. So you can redeem those securities that you've grown in the market for a while and use that for a down payment. And you still haven't changed the nature of the original borrowing, which is borrowing with a reasonable expectation of generating income.
This is awesome.
I invest in securities, I sell, I take the cash, I buy investment real estate.
Oh, wow. Oh, wow. I personally will need that contact so I could follow up and implement it. What I've done so far, and I'm open about this with everyone out there, is I've always just tried to pay off my primary residence as quickly as I can. So whenever I had a lump sum, commission come in or a lump sum client come in, I just would put it all towards the mortgage. And I'm lucky that 50% of my mortgage right now is paid off on my primary. So are you saying use that 50% now, or are you saying, like,
well, you're going to have,
what would you do if you were in my shoes now?
Well, you're going to have significant equity in your home. If you paid 50% of your mortgage off, meanwhile, and you didn't borrow 100% of that mortgage to begin with, you only borrowed 95 or 80% to begin with. Now that mortgage balance has declined by half, plus the value of your home has increased a little bit, you're going to have significant equity. So if you talk to a certified professional mortgage broker, which I can connect you with, then he's going to say, or she's going to say, hey, guess what? You've got $100,000 that you could pull out as soon as we refinance you. In order to be able to implement the Smith maneuver, you can get going on that, but you can also pull out up to $100K or whatever it is, the day that your mortgage refinance closes. And so now you go and you buy a piece of investment real estate.
Wow.
And implement the cash flow dam on top of that.
And that mortgage broker will work with the financial planner who's also certified to make sure I'm following through with everything properly. Because it sounds like you have to follow the steps properly in order to make sure it all becomes deductible.
Yeah, you do. So, like, there are discount investment brokerages. We know robo advisors, Wealthsimple, these types of things.
Right.
Now, there are a lot of people out there. They implement the Smith maneuver, but they don't want to use a certified financial planner or investment advisor because they feel, maybe rightly so, that they know enough about investing and they're going to go to a robo and do a nice index fund, nice and responsible blue chip index fund. And that's fine. So what we have in these cases, if they don't have the guides, the professional guides for themselves, we have what we call the Smith Manoeuvre concierge. It's tough to say. Smith Manoeuvre concierge service. So we've got someone who is a consultant on the cash flow management side of things. So they're not an investment advisor. They're not a realtor, right? They're there for the client to say, okay, well, let's manage your cash flow. What do you need to do on a monthly basis? What do we need to do to make sure you're not messing up your cash flow down? What do we need to make sure that you're getting the appropriate information to the accountant at tax time?
Mm-hmm.
So there is always going to be a certain amount of do-it-yourself element, do-it-yourself.
That's right. You got to be on top of it, like anything.
And we've got help for that as well.
That's excellent. Yeah, because we're all busy. It's easy for us to forget something or miss something. So the very fact that you're offering that as well, that would be helpful for me, right? So that's great. And then let's see, do we have enough time for another question here? Where can I buy the book?
Smithman.net.
Smithman.net. And I guess it's also on other platforms like Amazon, or no?
Yep, it's on Amazon.ca. In fact, I just checked the rankings yesterday of book sales, and it was number one in personal taxes, number one in mortgages, and number one in
well done
category, something like that.
So question, are you able to autograph if I get my book?
Yes, certainly.
I think I have one already. I have to double check. Yeah, you did give me one, and I think you did autograph it already. But for others out there, man, this COVID is affecting me.
It's telling me that you haven't read the book yet.
Okay. Oh, I have. It's just life is busy. But no, like you said, procrastination, you just got to do it.
Yeah.
And so now I think really, and especially now it's tax season. I think the extension now is till July, is it?
That's a good question. Don't put me on the spot. Sure.
Yeah, no. Yeah, and we got it. But I believe there is an extension now. So I do have time, and I would love for you to give me those contacts so that I can follow up and see how we're going to set this all up, and follow up on it, because I don't want to delay and miss out on this opportunity to have some savings. So this is great. Thank you so much, Rob. And any more questions, please email. There's an email that's going to go out to everyone. Please email it back. And there's also going to be a recording of this so that if anyone else needs information, we will send out the recording for you to share with your friends as well. So thanks again, Rob. Have a wonderful day. Be safe, everyone. And we'll all be in touch soon.
Thank you very much, Sharon.
Okay, cheers. Bye.
Bye now.
Bye.